The US budget deficit has decreased to $1.6 trillion for 2025, the lowest in 3 years, fueled by a record rise in customs revenue from Donald Trump's tariffs. But challenges loom ahead with potential Supreme Court rulings on those tariffs and declining corporate tax receipts as well. For more, we're joined by David Scutt from StoneX. Good to see you. What factors are contributing to the decrease in the US budget deficit? Is it just about these tariffs?
G'day, Aaron. Great to be back. Look, it's not just about the tariffs. There has been some pretty solid growth in the United States, of course, and that does help to go and boost revenues when it comes to the taxation side of the equation, even with a big, beautiful bill kicking in late in the year. But it has definitely been a fillip that's gone and boosted and narrowed that fiscal deficit. So we're now sitting at around about 1.67 trillion for the year. But that being said, mate, it's still 5.9% nominal of GDP, which is an extraordinarily large figure considering how strong the US economy is right now. We have very symmetry fiscal settings.
It's interesting because, as we say, we know that the tariffs, according to the president, have been bringing in billions of dollars from overseas countries to the US coffers, but spending is going up, particularly when it comes to military, which of course is where they spend a lot of their money.
It is, and that's where the problematic scenario could play out. You mentioned another court case. We didn't hear from the Supreme Court of the United States last night. They're scheduled to go and rule on the legality of the reciprocal tariff. So this is not all tariff revenue, the $264 billion or so that was raised last year, but it's a fair chunk of that, so it's important. And so what that ruling implies is going to be very important for not only what happens to the fiscal side of the equation, but what happens to US treasuries and potentially the US dollar as well.
Talk to us about how customs revenue is impacting the overall fiscal health of the US, and is this something that carries on? Because we have assumed that there would be a brief hit when it comes to tariff revenue, but then other countries would find a way around, perhaps stop it. What do you think?
Look, the tariff revenue itself is doing a very, very important job, particularly in the treasury market. So what we've seen across the developed world over the past 12 months or so is that the long end of yield curve. So what we're talking about is government debt, sort of 10 years and longer in duration. And it's been selling off by and large, except in the United States. Now, that's not really being influenced by monetary policy and what the Fed is doing. It's more so to do with what the fiscal trajectory is expected to be. And because we're getting that tariff revenue coming through, it's helping go and keep a sustained bid in those long treasuries. And that's been a really important factor, which has also helped to support the US dollar as well. It's outperformed many people's expectations. But if that was to be taken out of the equation, if that revenue had to be refunded, they couldn't collect any more, that would go and reverse those trends. And that's where it could get very, very gnarly for riskier assets like stocks.
What about Doge? Does that have much of an impact?
At the margin, I would say very, very minimally. But we're talking about a rounding error when it comes to the size of the US economy. Yes, they're seeing some job losses. That's gone and reduced some of the outlay when it comes to the staff expenditure on the public service. But it is a real rounding error, and that's probably being kind.
It's interesting because there was a lot of concern that there would be an impact on inflation as well, but the US Fed looks like they'll be cutting rates as opposed to Australia, where it looks like the central bank will be increasing rates.
It has, and it surprised a lot of people. There's still evidence that there has been some tariff pass-through, but it hasn't been anywhere near as much as what people are anticipating. We actually got some producer price inflation data out in the United States for November and October, released overnight. It's delayed because of the public shutdown. But what that showed is that we're seeing a lot of those wholesalers really absorbing a lot of those tariff increases before they're going to pass it on to retailers. So that's been one factor behind that. That points to the potential for margin compression unless there's some cost cutting coming through as well. But how sustainable that is over the longer term, well, that's another question. But as things currently stand, mate, it looks like that tariff shock and the inflationary shock is not going to be anywhere near as bad as what many people first believed.
Yeah, I mean, it was huge news all of 2025, particularly the first half, as President Trump was inaugurated and the tariffs came in. There were these tariff wars, of course. There were concerns that this was like putting rocks in your own harbour, that it would have a massive impact on the US economy, and it just simply hasn't. Do you think that will mean that other countries may follow suit?
They say no in public. In private, there's probably discussions. You look at what's going on with China in particular and how it's had to go and circumvent this changing landscape. There's some trade data out yesterday. The value of exports to the United States in December was down around about 30% on the same month a year earlier. That's a huge drop-off, but it's gone out to almost every other part of the world. There's been some transshipments, which means that basically it's been made in China, rebadged as being produced in another country and sent to the United States. But where that comes from, other places around the world might get a little bit upset at what China's practices are doing. So you can't help but think that if there's going to be any movement when it comes to trade barriers, it's more likely to be more restrictive settings this year rather than less restrictive.
But what if tariffs are deemed illegal? I mean, you mentioned before about the courts. What happens to all of this wonderful revenue coming into US Treasury from customs because of tariffs if they're deemed illegal?
Well, that's going to be the multi-trillion-dollar question, because no one really knows what the Supreme Court is going to go and say. You look at prediction markets at the moment, and they say that it's not quite a slam dunk, but they think that the Supreme Court is going to rule these being illegal. But that's not really the question that markets and investors and traders need to go and consider. What really matters is going to be what it rules as to whether that revenue can be collected under other legal means. Now, that's what most people, I think, are expecting. That probably explains why markets are pretty sanguine about the risk, and there hasn't really been a big reaction. But if you see the Supreme Court say, it's completely illegal, you can't go and do this, you have to stop collecting this tariff revenue, and you must refund revenues already raised. We talked about the deficit at the start. That would balloon. And so those big important factors I was talking about when it comes to the US dollar, when it comes to long treasuries, they would likely sell off pretty aggressively. And now, in an environment like that, when you talk about valuations, and we're talking about what are supposed to be the premium risk barometers of global trade and commerce, what the global borrowing cost, the global reserve currency, if they're in trouble, that is not a good environment for risk appetite.
Speaking of in trouble and risk appetite, Donald Trump's 10% credit card max limit, what impact has that been having? Because the banks have really copped it this week.
They have. I've got to say, the bank earnings, by and large, have still beaten expectations at the key metrics. But it's really instructive as to what's going on. It comes to the data comes out, the figures look great, and then the share price sells off. So it tells you one thing, that the bar for earnings expectations is extremely high now. We've seen this big run up in bank valuations, and look, let's be honest, most other sectors as well. And these earnings are coming out, they're looking pretty decent, guidance is okay. And then we're seeing these big share price reactions, big falls. Wells Fargo was one of the few banks that actually missed on some of the key metrics overnight and got hammered. But when you look at what's going on, you can't really read through as to whether it's going to go and apply to other sectors, because we've got this credit card 10% cap that wants to be put in place by Donald Trump on January 20th, so not long away. Now, what that's going to do, it's really going to go and cause a contraction in credit. It's going to be credit rationing, as it's called in banking, because those lenders will not want to go and give very, very cheap loan rates to borrowers who may not go and pay it back. There's a fairly large loss rates when it comes to these particular products, and so those mean they won't get issued to them. So it's bad for earnings. It'll probably be bad for economic growth, particularly when it comes to consumption. But it may actually go and benefit the likes of buy now, pay later providers, because it will probably force those consumers who can't get credit to go to those riskier places. So that's something you keep in mind as an investor.
Yeah, it's really fascinating, obviously, because historically, Republican administrations have loosened rules when it comes to banks that often then have led to financial crises, of course, as we know from a history lesson. Just quickly, let's finish on commodities. What started off with gold has now basically spread to everything.
Yes, the metal space is running hot, and that's probably an understatement. Appropriate graphic you're putting up there. The price action at the moment is unbelievable. What you're looking at here on that left-hand pane, that's the Bloomberg Precious Metals Index, and on the right we've got the industrial metals. And you can see precious metals really have ripped high. You mentioned it started off with gold, but silver is the latest. It's really running hard. Platinum, palladium are also starting to go and rocket higher. And you can see when it comes to the industrial metal space as well, it's now starting to go and break out to multi-year highs. So when you put that together, there's a lot of different factors. For one of them, we're talking about these really stimulatory fiscal settings around the world. That's one. We've also seen central banks cutting rates very aggressively as well. And then you go and throw into the mix the likes of concerned about tariffs and trade and geopolitics, particularly around what's going on in Iran, and of course, what's going on with the Federal Reserve. And it explains a lot of the price action. They are now being treated, those assets, as safe havens.
It is all happening. David Scutt, appreciate your time on Ticker as always. Thank you.
Great to be here.